Okay. Hello, everyone, and welcome to our maiden episode of Fun and Learn Fridays with 5paisa.com. I am Deepika Asthana, your host for the evening. I think that one of the overarching goals that every individual has is to attain financial independence, to be able to buy the car that they really want, afford the holiday which they really need, and protect their loved ones. Unfortunately, not many people are able to achieve this. लेकिन क्या आपको पता है कि just by making the right investment moves, you can cruise your way to financial independence? And that is exactly what we are going to be talking about today. So, without further ado, let me introduce you to our first guest, Mr. Ujjwal Jain, founder and CEO of WealthDesk. Ujjwal is young in age but ancient in terms of the varied experiences that he has had in building and creating investment solutions for leading global firms like DE Shaw and MSCI. He is a computer science engineer and a CFA charter holder, truly multifaceted. He is also actively involved in ensuring last mile access of financial products. Welcome, Ujjwal, and thank you for being here. Now,
Hey,
let me start. Sorry, go ahead.
thanks, Deepika, for the introduction.
Lovely. Okay, so let me start with something that is on everyone's mind: wealth creation and financial independence. A 25-year-old who has just embarked on his earnings journey would have several investment options to choose from. There are stocks, there are mutual funds, there are ETFs. Yet this individual, in all probability, will not be able to create wealth. So my question to you is twofold in nature. Why are retail investors actually not able to create wealth, and how wealth baskets can put them on the right path to wealth creation?
Hey, thanks, Deepika. So, thanks for hosting me for such an interesting show. And your question actually is a question for every investor who opens a broking account, especially when such a surge in India right now, where people are realizing that there's a long-term wealth creation opportunity on top of broking, and by opening a broking account. Like, so with that as an intention, there are many retail investors in early young age who just started earning money and have a good sustainable savings. They started to open broking accounts. But opening a broking account is one thing, creating wealth through your broking account is another thing. So the biggest challenge actually is also something which is very personal to everyone, like including me.
Mhm,
Like I,
mhm.
like you just introduced me like multifaceted computer science guy, worked with DShaw, MSCI,
All
built this
true.
great company. But when it comes to personal investing, I can tell you from experience, like though when I remember that I joined industry post crisis, only 2009
Mhm,
post crisis. And I come from like my background used to be very lower middle class, and we used to be very risk averse as an individual, like
right.
as a
Mhm,
family. But one thing we were very clear about as a family was that we always used to invest in equities with a very long term horizon. Like my father
mhm,
used to do IPOs back in 90s 2000, and I have seen how their life changed in the long run because
right.
of those
Mhm,
investments, not from their
mhm.
primary source of income, which they do used to do from their jobs
That's
or a
right.
business,
Mhm,
but their wealth that they accumulated through these long term
mhm,
investments, that actually helped go through a lot of financial turbulence that we had seen when we were growing up. But when I post crisis, when I joined industry,
mhm,
because I started with my own money which I was making through my
mhm,
job, the risk averse attitude was fundamental. And
mhm,
initially there was some friction that whether I should open a broking account or not, and start investing in direct stocks or not. Then some, obviously the culture was to actually invest in equities. So I opened up a broking account very early age, like
mhm,
just after doing my first year of my job. But the moment, with so much of information from my institutional background in markets, like being in hedge fund, and even at that point, when it comes to my personal investing, I could see that with so much of knowledge around. And
mhm.
typically when you open a broking account, you don't have any organized investment solution. You have 6,000, 7,000, and ever expanding stock universe
Talk
and
to
ETF
you.
universe to invest in. So, and because your behavior also says that I know so much about the markets, and obviously you have so much of access to information, and you feel that I can actually find the right stock to invest in, and then you end up starting investing. And also happens is that because stock markets is one of the most talked about thing in general parlance, especially in young
Right.
population, because they feel empowered that I made money in this stock, you should also invest in, or I find this route stock in this sector, electric vehicle is doing great. As an industry, you should invest in this power stock
Right.
because
Right.
they are creating those electric charging stations across the country and
Right.
these
Right.
things. And then they say, okay, this is a great stock, somebody told me. This is how a typical broking journey starts. And the moment you end up investing in some like whispers that is floating around, or market news that you have seen, you might have accumulated good information when you started investing in that stock
Mhm,
at that point in time. But
mhm.
is that, will you be able to track that stock in the entire investment life cycle when things will change with the fundamentals of the stock, or industry trends changed and that stock is not fundamentally now going to create long term wealth as you're looking for, and maybe some corporate governance issues or anything? Because see, a stock is when you invest in a stock, the stock's price can be impacted by many things which is beyond your sources of information. And also the fact your day job is what you're doing, that is what we call as human capital. Like I am
Correct.
making money by doing whatever I am good at, and when I'm investing, I'm investing in something for my financial goals, which is going to come in a later point in my life, as you
Right.
said, financial independence. So so that stock investing I did with a lot of adrenaline rush and with empowerment of
Mhm,
information and all of that. But tracking that stock to ensure that it creates wealth for you in the long run, the problem lies there. So because that's not your day job, you feel like you have enough information, then you but
mhm,
you don't. And when you make a mistake, that further compound because your behavioral bias starts creeping in, behavioral
sure.
biases, where you feel like, okay, I invested at this price, I will wait till the stock reaches this price or cross that, and then I will exit. And this is for a stock which goes down in case you have invested. For a stock which has gone up and actually you made a fortune, you end up selling at a average at a price which from there it actually goes up, doubles up. So typically a broking account opens up, and after a year or so you will see a broking account with a snapshot. You have a bunch of losers and not so many winners in your portfolio. And then you start to tend to become a dormant like investor, because you start to believe that direct stock investing is not easy. And this is the fundamental problem with the stock investing, especially on a broking app where you have access to direct stocks and ETFs to invest in. But the same investor would have actually done very seriously his investments in, let's say, gold or real estate, as they tend to create more savings, or maybe even mutual funds. Like, because mutual funds, for a direct equities exposure, mutual funds are a great investment vehicle because they provide a fund structure which are managed by experts, and you have access to that. And you tend to look at mutual funds with a very long term view, because you believe that it is for my long term wealth creation and it's going to support me in the long run. But direct stocks and ETFs, for largely many young investors, they don't look at it from a wealth creation point of view. They start to looking at it that, can I make quick bucks? Possibly many are smart, like, but they are reasons to actually fall trap to, because there's so much of information around. So what essentially, as you introduced our offering, which as a platform we bring to the retail community on broking, is Wealth Basket. So Wealth Basket is a portfolio, is a bunch of stocks following an investment strategy or theme. And these wealth baskets are created by like credible, renowned, SEBI registered investment advisory firms or research analyst firms who have the capability and wherewithal and the institutional understanding to create these portfolios on direct stocks and ETFs, and manage it also as they continue to manage it. And what are these portfolios? These portfolios could be part of could be a long term portfolio following some fundamental investment styles, could be a factor based or a quant based or a smart beta long term portfolio. It could be a theme. It could be a theme which has a long term wealth creation objectives, let's say a digital India or a make in India or a MNC growth. Or it could be a sectoral portfolio around pharma, electric vehicles, digital India, chemicals, and all. So, and these portfolios are available to you on your broking accounts as if like a direct stock, but with the essence of organized portfolio. So what happens is that instead of trying to empower yourself with individual stock investing, which could be disastrous for you in the long run. What you end up doing is that you are empowered, still empowered, because you know that there's a long-term theme in consumer space, or there's a long-term theme in digital India space, and then there's this right portfolio out there as a wealth basket on my broking account. I can go ahead and invest in that. And the best part is that when you invest in that portfolio, not only you are investing in a bunch of stocks which are intelligently weighted by the by investment advisor or the research analyst firm, you replicate the entire holdings on the underlying stocks in your own broking account. So you have complete access to those direct stocks only. But when you start looking to look at your direct stocks which are invested through Wealth Basket, you start to look at it as a portfolio level, just like your other mutual fund or a gold or a real estate investment, where you are have a very well defined objectives. So when you start looking at your broking investments through these Wealth Basket, you start looking to at these individual investment strategies and portfolio. What happens is that you tend to actually get organized in your direct stock and ETF investing, and that is the process that we bring to this entire retail investing on broking through Wealth Basket. And the best part is that once you invest, you are not on your own. You are not in an OSIN where you don't know how to move forward from this investment going forward. These portfolios are managed in nature. So the investment advisors, the research analyst firms are constantly ensuring that the research style or the investment theme of this underlying portfolio are well taken care of to achieve the risk return expectations on this portfolio. So whenever there's a change in this portfolio based on the investment style or the research, you get an update to as a notification where you can see basis my investment amount, these are the impact in my portfolio, and these are the buys and the sells at the stock level or the ETF level. I just do a one touch approval, and I am my portfolio again updated. So in your entire investment life cycle, from you're investing in your Wealth Basket during your first time investment till you are invested in that Wealth Basket, your portfolio is managed, which makes it so process driven, so systematic, that you tend to create wealth on broking. And that is something which actually a larger retail community needs when they open a broking account on broking platforms. So Wealth Basket essentially ensures that the wealth creation objectives on direct stocks and ETFs achieve a larger retail community. And these Wealth Baskets are actually accessible to retail investors because the technology or the platform play that we have enabled to retail community on broking, that they are available, which could not have been available in the past because of the structures where it is very like inefficient, operationally not possible, or cost wise also not very prohibitive for good managers to actually create portfolios for larger retail community. So the same premium managers who used to focus on a very small set of investor community, mostly ultra HNIs, they are gradually moving to retail through our platform and bringing the same premium investment solutions on the broking platform, and at a possibly affordable cost as this market evolves further. And these premium investment solutions are now available on broking platform. So if I would have asked my 25-year-old, had I started my first broking account and I would have access to a good ETF packaged Wealth Basket for like bunch of ETFs packaged in the right way to create my first multi-asset portfolio, or maybe of India's top 500 companies related, some long-term portfolio created by some great fund managers, or maybe in that at that point there was a lot of themes that were going when I was 25. I'm 34 right now. So I could have got those access. I would have made more money than what I have made as an individual investor now, because at that point there was no Wealth Basket. But today you have a Wealth Basket, and as a retail customer, you should try to invest smartly on your broking apps.
So actually, that is a really nice overview of what your product offering is. And while my next question was going to be why should I invest in a wealth basket versus a stock or a mutual fund, I think you've covered that beautifully. But what really stands out for me in what you've just explained is, of course, the access to these curated portfolios which are managed by quality investment managers, but also this whole thing around access to specific themes which maybe like as a mutual fund investor might not be able to access, like you said, the digital India theme or a technology theme, or like an AV scheme, maybe EV vehicles theme. So that is one thing which I think is a great value add for a retail investor. And secondly, the bit you said about the really sophisticated investment strategies are not really accessible to retail investors, right? But through a wealth basket, we can access these sort of investment strategies and themes. And like you said, it's all transparent in your broking account. So I mean, one feels empowered because you know you're kind of in control of your wealth, even though somebody else is kind of managing it and helping you take the right decisions. So great, that sounds good. But I think in the investment world, trust is the most precious commodity, right? So if I'm buying a wealth basket on the WealthDesk platform, how can I be assured of the quality of the investment managers? Because I think in this case, quality definitely trumps quantity, right? So it would be great if you can walk us through that.
Yeah, Deepika, it's an excellent question, because if you ask me, the universe of managers who can create portfolios once they get access to a platform like WealthDesk, so that they can serve the retail community, it's a large opportunity. Like, I can actually have many managers on our platform, but then I'm actually not solving the fundamental problem of retail investors, because he's already confused with 6,000, 7,000 stock universe. India actually is one of the highest listed, like, the number of listed stocks in our country is highest comparable to other even developed markets, and we are expanding with so many IPOs coming, and we'll be further penetrating the capital markets. Now, with that as a opportunity set for a retail investors, if I bring many managers, I mean, am I doing justice where I am creating another layer of wealth basket, which are so many that I'm again confused? So that is one thing. The other thing is that fact are all can most of the managers that who have the relevant license, can they serve the retail community at large and provide premium solutions? That's another question. The third is that the fact is that when you look to invest, like if I am an investor and I am looking to invest in a real estate property, I definitely look at premium brands. Like, say, if you are in Mumbai, you definitely look at Godrej or Hira Nandani, and you try to see if there are, because they are incredible brands. Why? Not because even if the apartment is out there, you can see that apartment, okay, whoever is the builder, but ensuring the longevity of that property, the bigger real estate brands works, and we all know that. Similarly, it applies with every consumer thing that we buy. We really look at the credibility from a longevity point of view. So in when you create these wealth baskets and make that available to retail investor, it is not about that first transaction in that wealth basket that is important. It is also important that you continue to provide them the return and the risk expectation that you have uh, position into your portfolio construction, and that as a manager and made available to retail investors. Are the managers, all managers, capable to achieve that? Like, so because even in AMCs, so some scheme gets shut because of fund manager biases and challenges, and a lot of other things which we know. We have so many case studies around. So with all that as an information, we as a platform, we have foundation, as a foundation level, we have decided that we will only focus on, as a platform, we will also focus on this manager selection process, which ensures that the managers who are coming on our platform to create these portfolios and who have the relevant licenses, they, whatever their investment themes and strategy or research capabilities are, whether they have the history, the academic professional credibility to do that as a corporate entity, and also whether they can accumulate large AUMs when our these portfolios get accessible on the broking platforms to a larger retail community. Can they handle those large AUM? Because it is also important to actually capture so much of investment amounts from these investors and still provide you right returns. So those things comes into our quantitative aspect, and the fact that on a sustenance model, are you following the right research process, risk return attribution as a fund manager, because these are fundamental to fund management. And when retail investor is investing, he is empowered that he's investing in the right portfolio, so that empowerment needs to be protected in the long run. So all of these ensure means that as a platform, we do a very stringent qualitative and quantitative manager selection process, whether as an entity they can achieve all of these objectives, and the research they bring into the table, are they really credible in that research style? Let's say, for example, if we got a smart beta or a factor based or a quant based fund manager on our platform, we have looked at the research process, whether when they say that they look at 20-year of back tested data, are they ensuring that their back tested data has no look ahead bias, no survivorship bias? Now, these are very complicated stuff, but from a retail investor point of view, I could say simply that when you build a quant based portfolio, which is largely data driven, you build models, your data needs to be built, constructed in a way that you are not putting any bias in your research strategy, which is like how typically a globally MSCI would do when they construct an index for an ETF, or a State Street, or an or any index provider would do globally. So we also ensure that for the retail community, when these managers are coming with these quant portfolios, are they ensuring all of that in their research process? So let's assume that so much of heavy lifting has gone in the manager selection process to get something on the retail investor front. So when you are investing in a wealth basket specific to your investment objectives for a long term or a short term wealth creation, you are rest assured that you are investing in a credible portfolio manager's portfolio, and that is something which we follow very stringently.
Perfect. I think that is very, very reassuring because otherwise, there are, like you said, already about 6,000 plus listed stocks. And if they're just going to be another hundreds of wealth baskets, I hardly think that is making the investor journey easier, so to speak. So that is definitely reassuring to know that there are stringent quality checks from an investment advisor perspective on the platform. So now let's get into something more realistic and tangible. So if I wanted to do a Zindagi Na Bilegi Dobara kind of a trip with my friends in, let's say, 3 to 4 years' time, which wealth basket would help me accumulate the required funds? Or more specifically, we would love to know what wealth baskets should we invest in from a medium to long term perspective.
That's a great question. First of all, tell me, is Europe open now, or will be open in next 3 years because of
Well, here's
pandemic?
hoping, yeah, hoping that soon it opens.
Cool. I mean, I think that's itself is a great thing, because then we can plan the vacation. So yeah, so that's a great question actually. Good is that you have asked this question, because when you are investing your savings into something, you should have some tangible goals.
Tangible
Ki
goals,
why
right?
I'm investing? Because if you don't
Mhm.
have tangible goals, you might go haywire with your
Correct.
investment, because then
Mhm.
it becomes your, at times, asset becomes liabilities also. And that is because you didn't plan it well. Like, why did you
Sure.
invest in that?
Mhm.
So
Mhm.
it's a great question, whether it's a Jindagi Na Bilegi Dobara trip, or a retirement planning, or buying the
Correct.
next
Correct.
home.
Mhm.
There should be some objectives, very
Mhm.
very important. Now, coming to the Jindagi Na Milegi Dobara kind of trip, like, because it's a
Mhm.
vacation, it's a luxury vacation, so
Yes.
it's a very discretionary spend. Like, so today, even if I decide that I want to do a Spain trip in 3 years, later after 3 years, if something happens which is emergency from a funds deployment point of view, I can avoid that trip. So with that as an intention, it is a optional discretionary spend. So today, what you should look at is that what part of my savings I gonna deploy in my wealth basket investments that I don't want actually for the next 3 years, which is very important, because that is how you keep surplus savings which you don't want to touch in the next 3 years. You that is the that First of all, that part of your savings you are using for this investment. That is one thing. The second thing is how much you have to, like, as of today, like, to actually deploy immediately, and maybe gradually through your salary, or through your monthly earnings, you're going to deploy over the next 3 years. So these things are also important to know. And the next thing is obviously your risk appetite. So for example, knowing you, I would say that you have a very aggressive risk appetite. I mean, you can take concentrated equity bets, knowing your background and knowing that you know markets so well, so you are ready for the ups and the downs, knowing very well that in the 3 year 4 year horizon things will work out well. And that's how long markets behave, with ensuring cyclicality and the volatility. So with that as an intention, if let's say I look at a persona who's medium to high risk, and assuming you are investing in equities, you have tend to have that kind of risk appetite. And knowing the amount of money I have today to start my objectives with this Spain trip goal, I would maybe tend to invest in something like a systematic smart beta or a defensive momentum portfolio, because it's a bridge between active and passive. When I say active and passive, the thing is that, so these portfolios, especially the defensive momentum, it follows price trends, and price has every information. And trend following is something which works well in India, and it has been proven academically as well as otherwise in the real world also. So so because I'm investing in equities, and this is the right way to create wealth in a 3 year horizon, I would try to put large amount of money in this defensive momentum portfolio. And what this will do is that, because these are managed, the underlying sectors and themes which it will rotate because of future updates this portfolio will be getting once you invest in this, will ensure that you are always invested in the right sectors and themes systematically by design. So you don't need to time the market or look at the right stocks and all. for your vacation. The portfolio will ensure that, because you knowing very well that what the portfolio theme and strategy is, it will give you the outperformance in the market in the next 3 years. So even if you start small today with an objective, let's say you want to have 10 lakh corpus for the Spain trip, you can ensure with this portfolio that you can achieve outperformance to market. This is the product portfolio history. And it will, because, and it will be, the sector rotations will be happening every month, and you make that changes in your portfolio. So this should be a significant chunk of your money could go into this portfolio. Apart from that, I might, because this portfolio will give me slightly outperformance to markets benchmarks, I might put some money in a maybe a more core ETF based wealth basket, which could be a bunch of Nifty Next 50, maybe even Nasdaq 100 or an S&P 500, and or a gold that mix, which has the tilt between gold, equity, and debt will be taken care by the manager. So sort of evergreen portfolio, the part of that could be put into that, which will ensure that you get at least the market returns plus something at a lesser risk compared to if you invest directly in a direct Nifty 50 ETF or a Nifty Next 50 ETF.
Mhm.
So that could, for somebody with a medium to high risk, this deployment of money in equities through these
Mhm.
wealth basket could provide that Spain vacation, hopefully.
So that's perfect. I think the pandemic notwithstanding, I think just a few investments and at least we're ready to jet set and go. So at least that's covered, right? I mean, that's a huge aspect of planning a trip or, like you said, any goal really. I think we have to work towards it and have some clarity in terms of the kind of money it requires, the kind of returns we require, and how do we get onto that path, right? Right. Set of investments that we can select. So I think from a selection perspective, maybe we can also briefly touch upon asset allocation. So if I'm creating a portfolio, right? Again, let's have a tangible goal like to buy a house in 10 to 15 years time in a metro like Bombay or Delhi or Bangalore. Then what kind of an asset allocation strategy would you broadly suggest? A mix of different wealth baskets, also maybe other asset classes, direct stocks, mutual funds. What should this kind of portfolio look like?
So Deepika, this is actually something everybody should do, irrespective whether they have defined their goal of buying a home or
Okay.
not. When they
Mm-hmm,
start investing in,
mm-hmm,
even through a direct stock or a mutual fund,
mm-hmm,
asset allocation is something which actually larger investing community does not know,
mm-hmm,
because that is some that has so much of I would say complexities involved to
right.
understand
Mm-hmm,
what is an asset allocation, what exactly it means. Though essentially as a process, a lot of us do it because you have some investments in gold, maybe physical golds or digital golds, and somebody have deployed money in lands, real estates, and depending on your appetite and capacity, and then you get into some mutual funds. So as an overall investment, if you look at your demat account, you might find some mix of multi-asset portfolio by design, but not many know that what should be my mix actually in the by design, like what should be my mix. So asset allocation is very fundamental thing. So there are a couple of dimensions one should look at their asset allocation with. Is, I mean, that their investments that you're gonna put in, what are the goals you are looking to achieve. So in your case that you talked about, that a home in from next 10 years, and if you're a young guy, you might think of buying a home at 35, you're 25 right now, which is a very tangible goal actually. If you invest smartly actually today, if you invest smartly today, you might be actually able to buy a home in Mumbai at 35 years. But if you don't invest smartly today, you might not be able to buy a home in Mumbai and after at 35 years. So today, that asset allocation discussion, if we are doing, and that somebody who is a retail investor or that gonna watch this video, if they think about it, not very like within a complicated manner, but in very simple ways, they are very easy way to look at everything. So some of the dimensions one should look at when they are looking to do asset allocation. One, they should look at their human capital strength. Keep how much capability I have to earn money today, tomorrow, every month, every year. And if it's for forward looking, obviously your risk taking capabilities should increase. So it's like I'm an engineer, engineers are like are always in demand. And I believe a lot of your consumers like who will be watching this video will be like engineers working in some great company, and they know that they have a great future and they are very good at what they do. So they know that they can take incremental risk as they move forward and they are young. So that's one aspect one should look at, the human capital aspect, how they are going to grow their savings and earnings. The second thing is that you need to always have the idea that whatever you are deploying when you're investing, you should have this demarcation between what is capital protection and what is capital appreciation. the money that you're putting into your investment. Now, capital protection is something which is so fundamental to all India's FDs. They are known that they are the greatest capital protectors. So that's why so much of savings money of ours are staying in bank accounts, knowing very well कि ये इसको तो कुछ नहीं होगा, ये तो भाई RBI backed है, 4% मिल रहा है. Protection तो हमारी, actually we are such a risk averse country by design, because we moved from so much of survival and then gradually evolved ourselves as an overall country, as a culture. That is why so much of gold at home. So capital protection is something which we all understand, and that is why not many people get into direct equity investing also, because उनको लगता है कि capital destroy हो जाता है if they don't do it smartly. So capital protection, and then capital appreciation. Now you are young, you have the ability to make money as you move forward in your career. Then why you should only look at capital protection? That is why you should look at capital appreciation, and that is when equities become a greatest vehicle to appreciate your capital in systematically in the long run. And that is where these positioning of wealth baskets, mutual funds, ETFs become very important, or even direct stocks. If you know which stocks to buy and when to exit, which if you are really good at finding the right stocks, investing in it and exiting it, you can actually uh, do direct stock investment. So from a capital appreciation point of view, equities become a very critical asset class that you should look at, and you should look at if you're young in your age and you're gonna have a good career professionally also. So as I told you, so human capital understanding of yours, capital appreciation, capital protection, and then once you have identified all these, like you've got a fair sense as an individual, knowing very well yourself, you got a sense, then you should look at, for your capital appreciation and capital protection, how should you build your long-term core portfolio, and how you should tactically, or like in the shorter term, in a medium term, how you should move money between different portfolios, so that you can tend to make wealth at a faster rate compared to just stay invested in a core portfolio. So core and satellite portfolio is a very simple strategy which anybody can look at from an asset allocation point of view. Let's say if we take a persona of somebody like 25 27 years old, that engineer working in a great company as a software engineer, or a, and has a very great career ahead. So he can look at a core satellite portfolio in a way that overall asset allocation should be 70-80% equity and remaining in more capital protection assets like debt, FDs, gold, and things like that. And with that as an intent, within the 70-80% of equity asset allocation, uh, how should I deploy my money between wealth baskets, mutual funds, and maybe direct stocks? Now, the good part with mutual funds, some of these mutual fund structures that are out there around, especially around debt funds, balanced arbitrage funds, and even large cap, mid cap, small cap funds, which are some of the AMCs have well managed funds. You can actually have some aspects of exposure to some of these mutual funds also. If you have believes that mutual funds are great, AMC is great, fund managers are great, you should have it. But they are uh, as the markets are evolving, the ability for mutual funds to innovate faster, to create better long-term portfolios, there's some limitations structurally. So comparably, for some of these long-term portfolio strategy, if you invest in a multi-asset ETF based wealth baskets, like that are like evergreen in nature, which have a good mix of India exposure, US exposure, or gold exposure, debt exposure, that should also be part of your core portfolio. So these ETF based wealth baskets should be part of your core portfolio. Deepika, you are on mute. uh,
Right.
uh, yeah, so that should be part of your core portfolio. And also, because you are young, and as I told you, let's assume that you have a good career ahead,
Mhm.
some of these defensive momentum portfolios, which in the long run tend to give real outperformance to markets, which are all these factor based, quant based portfolios, that can also be now part of modern day retail investors core portfolio, which was, I
Perfect.
mean, today we are could talk about these wealth baskets because that are now available to retail
Right.
investors on broking
Mhm.
platform.
Mhm.
Previously we couldn't. So
Mhm.
with that, actually you can create more personalized, more nuanced your
Mhm.
core portfolio. And tactically, I mean, tactically, because equities, direct equities are always looked at tactical, from a tactical standpoint, because that's why people are so, there's so much of activity that going into your broking app
Correct.
and looking at the
Right.
next stock. So tactically, wealth baskets actually can provide you that tactical moves also. So you like that digital India theme, or
Mhm.
digital tech theme, or electric vehicles
Mhm.
theme, or a MNC theme, or
Mhm.
even some sectors like pharma had a good run post COVID,
So.
like
Mhm.
flooded. Then chemicals, then maybe export oriented themes, or
Mhm.
some specific sectors had great run coming, and you expect that they're going to have a great run.
So.
These sectoral well baskets and thematic well baskets are part of the your tactical
Actually, portfolio.
portfolio allocation.
Mhm.
And because these are available on a broking platform, you don't need to find those right stocks by
Mhm.
doing your own research.
Mhm.
You can find these right managed premium wealth baskets, invest in that, and gradually try to see how you can tactically improve your portfolio so that you have better wealth creation in the long run. And core portfolio stick and continue to deploy, top up more and more, and you build your wealth. Overall asset allocation, you should continue to review that, because it
Sure.
is important
Mhm.
that something could happen to you financially, health wise, or anything, or some dynamic change in your real life, because there could be tail events in your life also,
Right,
so
of
that mix
course.
could
Mhm.
completely change also. So
Sure.
you need to
Mhm.
continuously review that. So this is how one should look at their investment goals on a broking platform. And very important thing is to have a very emergency deployed money in something
Mhm.
which ensures your capital protection, and you can draw out very anytime you need.
Very
So this
liquid.
could be typically,
Mhm.
depending on your lifestyle, it could be 6 months to 3 years. Like typically, somebody like me, coming from a very humble background in the yesteryears, I am more risk averse, so I would need 3 4 years of protection money. Like I know for the fact, if everything goes down in my life, I have those money that I can sustain the same lifestyle. So
Right.
this moment somebody looks at like this, they are already getting disciplined, and then when they come on broking platform and invest in these wealth baskets, they will be taking right investment choices.
Perfect. I think that sounds like a plan, right? I mean, I think it's been very interesting actually to know about one wealth baskets. But in addition to that, just generally in terms of how we can start our wealth creation journey through wealth baskets, other assets, and how to spread it across various investment assets. Perfect, Ujjwal. I think I'll just take maybe a minute to summarize our top five key takeaways from this very, very nice conversation. I think, firstly, to start with, it is important to achieve financial independence, and the journey towards financial independence should start as early as possible. Secondly, making the right investment choices can be challenging since investors have the onerous task of choosing and tracking their investments, and at the same time managing their own behavioral biases. This can have, sometimes very negative impacts on our investment choices and thereby impacting our wealth journeys. Thirdly, coming to wealth baskets, I think wealth baskets offer a great alternative as they give you an option to invest in a curated portfolio of stocks that are managed by expert investment managers. Again, adding to the wealth baskets, I think you can also choose from several themes and asset classes to meet your short term, medium term, and long term needs. And fifth, and probably I think the most important takeaway for me is the approach to asset allocation. Like you said, whether you have tangible goals in mind or not, asset allocation is the way to go. It helps us manage our biases. It helps us also incorporate any changes in the outside investment environment as well as in our own personal circumstances. And the best part is that it's highly customized, right? It's my risk profile, my return requirements, my views, my likes, and then to create an asset allocation strategy where you said you have a core portfolio which is largely focused on capital protection, and then you have a tactical portfolio which is primarily focused on capital appreciation. So that's my five key takeaways from this conversation. But Ujjwal, please, in case I might have missed out any of the key points, please do add to this.
No, you actually summarized perfectly. I think I have also learned few things that which I was
I'm
only saying.
humbled.
So reiterating back to, like, basically getting it back. So it feels like, yeah, I mean these conversations
Mhm,
are important when you are young, when you are getting into taking a open a broking account.
mhm,
It's a
mhm.
great step to a long term successful wealth creation story. And if you do it right with simple steps, I think there's a great like experience to actually create sustainable wealth and feel empowered that and I actually, one of the things which is very important as a country, because many broking accounts are being
Mhm.
opened right now as a country.
Right.
Like we've seen that there's a surge in broking account and penetrating deeper into B15 and other cities of India,
Mhm.
and because of the easy access to create a broking account in a couple of
Correct.
minutes.
Yeah. Mhm.
But the problem is that because stock investing has always been looked with so much of adrenaline rush, and if you lose money very early in your life on a broking app, you might become a dormant account. Like you might not even invest because you feel that you've lost so much of money, and there's a pain emotions goes into that. If you can smart invest smartly, and thanks to portfolios that like wealth baskets that are now
Mhm.
available on broking platform, you can actually control that rush. You still are still empowered, you're still holding the stocks, but you have the right curated investment strategies and things which you believe in and you can invest in, and gradually make systematic wealth, and you will enjoy the journey that you go through on your broking account for your overall investment objectives. So I think that's something which can actually penetrate capital markets deeper, and as an overall like, ecosystem, it's win-win for the entire community, both the asset managers as well as the retail investors.
Perfect. I think that sums it up well. I think I'll let you have the last word on this. Great. So thank you, Ujjwal, for your time, and wish you all the very best on this amazing wealth creation journey that you have embarked. I'm sure, like you said, the penetration for wealth baskets is going to be deeper, and it's going to empower an entire nation of investors, really. And I for one have had some great takeaways from this session, and I'm excited about exploring wealth baskets now. And thank you everyone for tuning in. Hope it has been as value accretive for you as it has been for me. Have a great weekend. Thank you.
Thank you, Deepika.
Perfect.